I don't want to just leave money to my kids, but I want to like create financial systems. The only way to do this and guarantee it and do it in the most tax efficient way is utilizing permanent life insurance, whole life insurance. To like just take that off the table and say that doesn't matter. You're self-insured. Leave your kids what you have, but you're leaving it in a less efficient way. And you're injecting risk into your ability to leave it, right? That's what we're talking about.
All right. We've been putting out some content around life insurance, and some people are very upset about the content. So we're just going to go through the comments. Mark, hope you're doing all right, man. Like, I want the best for you, and not sure, what all these comments are about, but hopefully we can answer these for you and get to the other side of it and get you focused on some value.
I in all the content that I do, and I know you do the same, we get comments a lot from people that disagree with our take.
Just fine.
Yeah, it's totally cool. I don't expect everybody to agree, and it's not right for everybody, and it is what it is. But I don't think I've ever had anybody spend as much time kind of trolling all of our content or my content. And like, he's not just leaving comments. He's literally watching every single video.
Yeah.
So like there's some thought that he's putting into this. And that's why, like, this is the first time I've ever made a video like this, responding, like dedicating a response to an individual that has done this. But like we were talking about before, I was like, honestly, dude, we're worried about you. Like, like if you're spending this much time, there's a lot of hate and a lot of anger and a lot of like.
And are you a financial advisor that doesn't do insurance or not quite sure what?
Yeah, we don't understand. But like we figured, rather than like writing entire books to respond to the comments, it's just easier to kind of go through the comments and respond to it.
Yeah, he says, truth is, all cash value life insurance products suck when compared to available alternatives. So I guess available alternatives is typically in this situation mutual funds, and we're comparing apples to oranges in that point.
Well, that's probably where he's coming from.
Right, because he's saying find a fiduciary. Most fiduciaries that you're going to find are basically assets under management, and fine.
Yeah. I think it's important to start with this, as we're looking at this and kind of breaking this down. What are your values? What do you believe, right? Like, so if you believe in the idea that savings doesn't matter, that emergency funds and like having access to capital doesn't matter, that you should go and take a ton of risk in things that you don't control, like maybe there's an argument for him. Like, and that's not the person we're talking to.
When what he's saying here too is that, I agree that there are those fortunate enough to have estate tax issues, because I mentioned, but the life insurance being sold to those who could barely afford it with the promise that they can make him rich. Okay. We just did a video where we talked about a lot of people probably should just get some term insurance.
Sure.
Because they don't have the cash flow or liquidity. If they're barely, paying their bills and they're struggling to get by, it's not going to be the timing for a product like this. They've got to just get ahead of, spending more than they make, or maybe overcoming a major health issue that they had, or a change in careers, or some type of setback. And that would be problematic if someone's putting all their money into life insurance, because there are people that are saying, put all of your money into it.
Right.
So Mark makes a good point there. I'm going to concede on that point, because I'm in agreement on it.
But if that's the case, Mark, like I promise you've never heard Garrett or I say that. So why are you trolling us and not somebody else that's actually saying it? I don't know.
So he's saying that it's not an asset, promoting it as an investment without calling it an investment. We've never called it an investment.
No.
It is. How is it not an asset? There's cash. Is cash an asset?
Right.
Is cash value an asset? Absolutely.
Correct.
Who would disagree that cash and cash value is not an asset?
Right. Technically speaking, your car, if you pay cash for it, is an asset, because it's a depreciating asset.
Even if it's a depreciating asset.
But it's an asset.
Depending on the car you buy.
Yeah, sure.
There are collectors. Sure. There's also just timing where there wasn't enough computer chips. But for the most part, in most economies, a car is a depreciating asset versus, an asset that could maybe go up in value. So there's another piece there.
Yeah.
He says, why should you ditch your 401k for a whole life policy? Well, look, first, let's just talk about some of the problems with 401ks.
Yeah.
I mean, my number one issue with the 401k is the same issue that Mark is saying there is with whole life. It provides a false sense of I've got what I need if it's the only asset that you have.
Yeah.
Because people are sitting there with the 401k, and I just did a video where I reacted to, they talked about the number of millionaires that were in 401ks. You know, the number one factor for someone being a millionaire, they started a long time ago and they put a lot of money in it.
Yeah.
And $1 million, I mean, okay, maybe you get 5.5%, or there's the 4% rule.
Right.
Like that's 40 to 55 grand a year coming from that. That's not really a lot for the people that put that kind of money in it. Like I get if someone is used to living off 40 grand a year.
Right.
That's awesome.
Yeah.
What about people that were making $120,000 a year max funding? It's
not going to do much.
Right. So there's no cash flow that comes from 401ks along the way. Mm-hmm. So the very thing that you have to do in retirement with your 401k is create cash flow, yet you neglect learning how to create cash flow along the way.
Right.
That's a problem I have.
Yep.
It's not a tax savings. It's a tax deferral.
Yeah.
The money that goes into the plan is no longer your constructive receipt of income, so you don't pay tax on it because it's in the plan, but the tax savings isn't in your tax return or in your pocket. It's inside of a plan to be taxed at a later date.
Right.
And if you want that money early, you might have some provisions to get to it through borrowing or through hardship, but otherwise you're going to be at a 10% disadvantage before 59.5.
Yep.
There's not only the fees of the underlying investments, which often are fueled by mutual funds that include bonds and other fixed income assets that have been losing value in an increasing interest rate market that whole life doesn't have that problem with right now.
Right.
And now you're also paying the legal fees, admin fees, and 12B1 fees, which are marketing fees for the fund companies. So there's a myriad of fees that happen inside of these that most people don't look at and say, how is this impacting me? So lack of cash flow, deferral instead of savings, underlying investment methodology and philosophy, because I know people that when they lose money in the market, they lose momentum in their life. They start to feel a bit depressed and sad. And we aren't looking at that factor with the 401k either.
No, I think that's all extremely valid. And
we're still comparing apples to oranges.
Yeah, exactly. I think that's important to understand. But I also think, listen,
but the title I have on there is just your 401k.
Sure. And based on like, listen, he's made a lot of really good comments, not good necessarily, but like I can respect the fact that he's got his opinion and he's done his, like, I could tell he's listened to the video and then made a comment. This one, he obviously, like, it could have been, he just read the title and was triggered. I don't know.
He says, who gets to keep your cash value that you paid so much to build up when you die? The insurance company, but we're going to look at a policy and we're going to see what happens to that death benefit over time.
Totally. And here's, I want to take a step back though and talk about this because I think this is a part that Mark isn't getting. And I know there are a lot of people like Mark. We're picking on Mark right now because he's been so active.
And very, like saying, we speak lots of words with no wisdom.
Right. Okay, fair enough. But like, yeah, exactly. So, but I think I want to take a step back for a second and be like, listen, what Garrett preaches, what I teach, what we each teach is not for everybody. Fair enough?
Right. And whole life is a part of the plan.
Sure.
But I'm always saying, pay yourself first automatically. Then second, the 4 I's methodology, which is save on IRS, interest, investment fees, and insurance expenses that you can start to minimize, and put that money back into your life. With that money, focus on building cash flow assets. But when in part of that process is, where do we store the money that you become more efficient with?
Right.
Do we want to store that in a bank? Or do we want to store that in cash value? That's where we're really at here.
Totally.
And that's the question at hand.
What I find really funny about situations like this, anytime I run into any person like Mark, is he's obviously very opinionated, very emotionally charged, and he's got his story that he's believing or that he's lived that's led him to this place. I don't know what it is. Like neither one of us do, but at the end of the day,
could have been about insurance policy.
It could have been a lot of things.
Who knows?
But what I do know is I find it interesting, the polarization and the complete opposite side of the pendulums when I talk to him. And I just got done going to going to this event and speaking at this event with all these people, entrepreneurs, real estate investors, dealing with taxes and like all this stuff. And every single one of them is in alignment with what we believe, right? Like if you think about your investor DNA and like what your unique abilities are, and you are an entrepreneur or you want real estate or, you're looking to invest for cash flow. That's not what Mark is talking about, right? Mark is talking about, and I don't know why.
There's no place for a whole life in Mark's life.
Right. And maybe there's a disagreement, but like, I guarantee based on his comments, he believes the best way to do things is to save money or earn more or earn money, put money in a 401k, invest in buy and hold assets, accumulate money, kick the can down the road, get money out of your own control, have somebody else really in charge of the success of your financial future, and maybe hopefully cross your fingers, it'll be enough, right? I mean, that's it. And so like, Mark, I got news for you. If that's how you feel, stop watching the channel. Like, that is not who we help, right? Like, and quite frankly, if you believe that that's the best way to do, you just shouldn't watch our channels. Like,
right.
Like, I mean, honestly, like it's pointless.
Yeah, Mark says his 401k is the reason he's able to retire at 55. So there's a fundamental reason not to watch this channel. I don't believe in retiring from the world of value creation.
Right.
I get it. There's a lot of physical labor jobs. There's a lot of terrible jobs out there that as soon as you can get out of those jobs, that's great. But then what next? Like, you know, had he poured all of his money in whole life policy, he'd be broke right now, he says. Are there some fees in 401k plans? Yes, but you live in a very fragile glass house if you want to bring up the issue of fees. Not to mention commissions. Please tell your viewers. Okay, first off, can you imagine how much more money would you have if you sold 401ks?
A lot more.
I'd have a lot more because I'm getting paid on the whole asset that's in there at the same rate for the life of it. And secondarily, if I want to sell that block of business, it's 12 to 15 times EBITDA. That's huge. Insurance blocks, because the renewals tail off, and the servicing of the policies, there's not really a good exit and selling that for money. Right. So yeah, you're getting paid a commission. And I agree that, that commission can be really high in that first year, especially on the base premium. But, you know,
but if you overfund a policy too, the commissions go down.
It goes down substantially. And could something be high commission and high value? I believe it definitely can. Can something be low commission and low value? I believe that's also something that could be true.
Sure.
So we have to look at the kind of the broader perspective here. He says that the sales pitch could be very appealing to the gullible, just like the bait and hook is appealing to a fish.
That's funny. Can we pull up an illustration? So here we go. I wanna do this real quick, Mark. I just want to talk about this for a second because this is important to know.
Because he's got to have savings outside of a 401k.
Yeah, you got it. Listen, and
what would happen to a 401k if you have a death benefit? You could actually spend more of that knowing that you've got a backup plan.
Let's take a look at this. So imagine we had a $6,000 a year premium and you have money in a savings account, because I believe if you're saving money in a 401k or investing in a 401k, you got to have some savings too. Fair enough. Because you can't be a good investor unless you have some savings and you have a foundation, because otherwise you're relying your entire life on speculative risky assets.
And let's just, the first thing you said, the insurance company keeps all your cash. Well, guess what? You started with $451,000 death benefit. And in the 11th year, it's $568,000. So
100%.
It's just gone up by quite a bit of money. They're giving you that extra money. So he's saying that you don't get that.
Let's go deeper.
But you actually do.
Let's go deeper into that, because so you start off with $30,000 and then you pay $6,000 a year. So basically what we're saying here is, yes, you go a little backwards, Mark, in your first year. You got, instead of $30,000 in a bank, you got $27,589. Okay, fair. I'll concede. But you have all these additional benefits. On top of the life insurance, you have the living benefits, which we spent a lot of time talking about, the importance of the living benefits while you're in retirement. We're not going to go there a ton in this, but like, that is not to be negated. Now, year two, you're putting in $6,000 and it grows by $5,941. Okay. Like
401k is going to, but if you have no term insurance,
but once again, I don't even want to compare to a 401k. I'm saying, Mark, keep your 401k if that's where your values and beliefs are. Like, don't even, like, I know you, the comment of that video.
Yeah, what's
like,
your portfolio is a different question. Right. We're asking, where's your liquidity?
Right.
Where's your risk management?
Where's your emergency fund?
Where's your,
just keep it simple and speak Dave Ramsey language. Like, but here's the deal. Year one, if you look at here, this column's increase in net cash value. It goes up. Year three, you're putting in $6,000. It grows by $6,234. Your argument, Mark, is that they keep the death benefit, or they keep the cash value. You started off with $451,000 of death benefit. You could see the cash value. You're putting in $6,000 in cash value, and so you're saying, it goes from $33,000 in cash value to $39,000. That's a $6,000 increase, effectively. Well, guess what? The death benefit went up by $11,000.
$11,000. Right. So that dispels this whole thing that he's throwing out there.
So he made another comment. We didn't see it yet, but he's like, "Why would I do this? I can get 4.25% in my high yield savings account." Well, that's great for you, Mark. And
What
it's
happened
great,
in the last 20 years?
Yeah, talk to me 10 years. Talk to me 3 years ago.
Yeah. What were interest rates 4 years ago?
Right.
0.5%,
Right.
0.25%.
So we have to think long term. Like, and granted, for the next couple of years, high yield savings accounts are probably going to be a thing. Right. But you don't solve long-term problems with short-term thinking. That's kind of my philosophy, and what we're doing here is we're getting, that savings dollar to be an emergency fund, but it's also going to be life insurance, and it's also going to be living benefits. And it's also, there's, and it's tax-free. So like when we look at this is going to grow tax-free. And so when we let's say you had your money in a savings account and you have we get to year 10 here and you got $93,000 in a savings account. That's the alternative, right? You could put it in liquid saved money in a CD or savings account or something like that. You've contributed 84, you got 93. Okay, you're ahead, right? That's going to maybe right now in today's environment, your savings account would be a little ahead of where you are here. But in all other environments that we got to take into consideration over a 30, 40 year period, that's not necessarily going to be the case, right? So, but when you die, if you die, and that money's in a savings account,
you get $93,000.
And it's going to be taxed.
Well, if you've already been hopefully taxed on
right. And it's been taxed the whole time. And as
so
it's
even
growing,
to get to 93, you had to pay tax on the difference between 84 and 93.
Exactly.
So you wouldn't have 93 unless you came out of pocket.
Right. And so that's something to take into consideration, right? And when this passes on to your heirs, how does it impact everything else that you have going on? And
so we're dealing with facts here for a minute, Mark.
Right.
And there's now $555,000 of death benefit. And how much have you put into the policy?
Right. So you started with a $450,000 death benefit. Actually, the death benefit is technically $420,000, and then you got $30,000, right? So $420,000. So you put in 84. What's 555 minus 84?
Yeah,
I'm not a rocket science, but it's 460 something.
470,
right?
yeah.
460, 470. So if we look at 470, you started with 420. You actually, the life insurance company is going to keep the cash value, but you actually end up with 50,000 more in death benefit than you started with.
Right.
I mean, I don't know. It seems like it makes sense.
You're still with more money than you would be in other alternatives. And let's say that. So let's just say that someone does a 401k. Mm-hmm. That 401k, if you take more than the interest, can jeopardize the principal and how long that lasts. So let's say in the last 2 weeks, the market went down 5%.
Yeah.
So he's 55, he's retired. His 401k went down. Wouldn't it be nice to have $93,000 and be like, well, it's going down. Why don't I just use my cash value for a little while? And you don't have to borrow it. Let's talk about distributions. Yeah. You can just take a distribution.
It's a great, we call that a volatility buffer.
Right. And so his other arguments were, why do I have to borrow from myself? And how dumb are you that you have to borrow your own money? Well, you don't. You can actually take money out.
Yeah, you could do it. So there's a concept. It's called withdrawals up to basis, right? So when you do that, you're able to withdraw up to the amount of premium. So at this point in time, let's say in this scenario, we got a 41-year-old here, but they're doing this, and they get to 65 years old, and they got $278,000, and let's say you're relying on $50,000 a year of income, from other assets that you have going on, and the market goes down 10%, and you don't want to withdraw money from a negatively performing asset.
The asset.
Right. So you got $170,000.
Are we allowed to call a 401k an asset? Based upon his definition.
But you got $170,000 of cumulative premium. So that's your cost basis, right? Mm-hmm. So in this scenario, you don't have to borrow against it at that point. You could withdraw up to basis.
Yeah.
If you wanted to, tax-free, right? So that's a great volatility buffer. Now, I honestly probably would still take the loan, personally, because of my values and my beliefs and what I do. But there's flexibility to do both.
Right.
And you can listen, I'm not going to sit here and preach to anybody acting like I know what the world is going to look like 25 years from now. You know what I mean?
Yeah, what I know is I don't know.
Right, exactly.
I don't have any idea.
And what I know is that this offers and provides flexibility and options for you to be able to handle it differently based on whatever economic environment we're in.
So you're not stuck one-dimensionally with just a 401k that may or may not be performing at the level that you want to perform.
Exactly.
So let's see what else.
Hopefully that helps with that too.
We need to educate the public to save more for retirement. Well, let's go to this.
Yeah.
Do we, or maybe that's an entire entirely erroneous philosophy and process too.
Yeah. Well,
So here's,
from that
because this is my consideration. Save more for retirement. Set money aside. Set money aside.
Yeah.
Where's the cash flow?
Right.
Where's the focus on efficiency? Where's the risk management? Risk management in that is usually diversification within stocks and bonds and within funds, not completely different asset classes. But here's the issue. You're going to wait for how long to accumulate this money?
I love it.
What if you start creating cash flow now?
God,
Plug financial leaks, engineer the wealth, and say, what would I need to create in cash flow to cover my expenses so I have that financial independence? Focus on investor DNA, so you invest in things that are aligned with who you are, so you become a better investor. If you own a business, look at ways you can grow that business without your direct involvement long term, and then invest back into yourself and your quality of life along the way. And then maybe you don't have to retire because you've enjoyed life along the way. And I get it. There are jobs that nobody wants to do, but we're in a world with technology and AI that it's just going to take a little bit more time for people to figure out what they want to do. But if you do that, you may not want to retire from the world of value creation. He wanted to retire at 55. I took months off in Europe and I was ready to come back. I like doing work. I like writing. I like doing these videos. Like,
we love
for me, it's a different philosophy. So I don't know that we need to educate consumers to save more for retirement as much as we need to educate them on cash flow and risk management. Part of the reason people are not financially independent is they don't manage and mitigate risk. So they're an incident away from having to then tap into the funds, or, you know, when the market goes down, they cash it at that time because they're scared. I mean, there's just so many other factors.
So I will agree that we do need to get people to see the value in saving more money, but not for retirement. Saving more money, you know, to deal and accomplish all the things that you talked about. Now, here's the other thing. Let's take everything you just said and put it into real life terms, right? Like, how many people thought they were doing well from 2002 to 2008?
Most.
And were doing on 401k. And you get this false sense of security because people look at their 401k values and they go, "Ooh, I'm doing well." But when that's all you're leaning on and you don't have safe, liquid, accessible capital outside of that, and then when times are good, that's fine, but then times get bad and the economy goes bad and you lose your job, or like there's like all these things happen. And if you don't have other money to help get you through, you know, then you're in trouble. That happened in 2002 or 1-2 with the dot-com bubble. That happened in 2008. That happened during COVID. And we're feeling the pain of that right now. And so, like, I want to make this like abundantly clear. We're not saying, like, if you think the 401k is for you, like, I'm not going to try to convince anybody out of that. For Garrett and I, it's not where our values and beliefs align with, right? Like,
right. And then he's saying here, I'm sure whole life policies have no fees at all, right? No, they absolutely do.
They do.
And what we're looking at is when you're putting money in a savings account, what are you not earning and what benefits do you have to pay for on the side? Whether that's long-term care benefits, whether that's, you know, life insurance benefits, and whether it's taxes, and what is that costing you? Whatever the insurance fees are they worth it after those fees on what you have versus having to outsource those or buy those in addition to what else you have going on?
Well, and when you look at 401ks, and like the average fees in a 401k are 1.5% to 2%, like that, and that's been documented over time. And when you look at that and you think about, like, you break it down of what the fees are in that, if you got $1 million in your 401k at 2%, you're paying $20,000 a year in fees. Like,
and he's saying that's only the high end, and I don't know.
Only the high end.
I mean, if we look at Edward Jones, that's low end. They're higher than that.
Sure. But if we break it down and we look at the low end of 50 basis points, that's still $5,000. You know, and like, granted, okay, that's not horrible, but I bet you it's more in the $10,000 range on average. And like, you know, and we're saying high end, like 1.5% to 2% is the average. They've done studies on this.
Well, this is where I'm really concerned.
Look up the Dalbar reports.
Yeah, he said that's why you should invest for long-term results and adjust your portfolio strategy depending on where you're at life. Aggressive when you're young and more conservative when you approach retirement.
That's so bad.
And that's right, so because let's just use this example. You're 20 and you get $100,000. You get to choose the year you lose 10%. You're going to get 10% for 29 of the years, positive, but you have negative 10% one of the years. So, by the way, if you have $100,000 that earns 10% over 30 years, it's $1.74 million. Not going to happen, but fine. Let's, you know, that's the weird assumption. It's 10% every year.
Sure.
Now you get to pick the year you lose the 10%.
Doesn't matter.
It doesn't matter. Yeah, it's only 10% of $100,000 in the first year, but that $10,000 loss has 29 years that it's now gone. And so this notion of, I could be more risky when I'm young because I have time is showing the ignorance of lack of risk management and basic skills around risk management that leave people vulnerable. And I'm concerned for someone 55 that's retired inside of a 401k being their main asset. Yep. Where is their volatility buffer and how do they manage that risk?
It is the biggest lie in personal finance. The younger you are, the more risk you can take. I'm going to play devil's advocate because I know there are going to be people watching this, and this is going to be their rebuttal. Okay, so I want to hear your response. But Garrett, you just dollar cost average, and that takes care of the problem.
So you want to be average. And by the way, if you got $100,000 and now you're going to dollar cost average, the dollar cost average is going to be small compared to the $100,000.
Right.
And the older you are, the less time dollar cost averaging has any level of impact because there isn't enough years for it to make any substantial difference.
Right.
So I feel like dollar cost averaging was an answer to how do we get people to put money in no matter what's happening?
Yeah.
That was the question. And the answer was tell them they're buying more when it's going down. They're buying less when it goes up, but it's going to average out over time.
Yep.
But it doesn't account for lump sums of money or previous sums.
So let me ask you a question. I really big on just saying, all right, listen, I don't try to convince anybody anything. I just try to get people to see, like, what are your values and beliefs? And I believe people struggle with their money because their money is out of alignment with their values and beliefs, right? The challenge that I have with 401ks is not that they're good or bad, is that most people that put their money in them, it's out of alignment with their values and beliefs. And I know this because I talk to people all the time and I go, hey, what do you think about the government? What do you think about national debt? What do you think about inflation? What do you think about taxes and the future of taxes, right? And they go, oh, I can't stand the government. I don't trust them. I believe taxes are going up because I think they have to because we're $33 trillion in debt. And I go, oh, where's all your money saved? Oh, it's in my 401k. Do you realize where you're struggling? There's like a massive discorrelation.
Qualified plan.
Right. And so the government's in control of your money, all these things. And so I'm not going to, like, I don't want to beat that too hard right now, but like at the end of the day, like that disconnection is a huge deal. And like what I think people just need to look at is just aligning those two things.
This is big.
Okay.
401k participants giving up more of their paychecks to Uncle Sam? ? Where did that come from? Are you not aware that 401k contributions are not taxed and neither are the earnings?
Oh my gosh.
Only when you
really?
retire and start to make withdrawals are they taxable. And then you're more likely to be in a much lower tax bracket. Okay.
Oh my gosh.
So you're planning to be in a lower tax bracket. Here's my first issue with that. Inflation alone starts to mean that you have to have more money to buy the same things. It pushes you into a higher tax bracket as that happens.
100%.
Because you have to have more money to buy the same thing. If this drink used to be $1 and now it's $5.
And it did.
You've got to make more money. Yeah. And when they say, well, you'll be in a lower tax bracket when you retire, how does that happen? One, is the government going to lower taxes?
Yeah.
Or two, are you just going to have less money? And does that less money allow you to live the lifestyle that you want to live? I don't understand that notion of you can have less money in retirement if inflation exists, taxes could go up, or interest rates were where they were for the last 18 of 20 years, where they were so low that it was hard to have a good cash flow. So that notion is we're going to plan on you failing in the future.
Yep.
Why would you want to plan for less tax in the future? If you're putting your money in a tax deferred plan, you're going to have less coming in.
And here's the deal. Listen, Mark, if that's what you believe, like I look at this through this lens, I say, I want to work with people as a financial coach.
Right.
I want to work with people that have the same values and beliefs that I have because those are the people that I'm going to serve the best. Right. Like, so if Mark, you don't agree with any of this, go somewhere else. Like do something that's going to serve you and your goals. Right. Like stop wasting your time here. That said, if you are putting your money into a 401k and you believe you have a crystal ball on what the government's going to look like when you hit retirement age, whatever time frame that is for you, if you believe you have clarity on what the tax rate environment is going to be for you, and you have a crystal ball around that, and if you have clarity on that and you are like have a high degree of confidence, maybe it's for you.
Right.
But if you have uncertainty around all those areas, that's our problem with 401k. That's my problem with 401k.
Let's look at this example. Let's say that we are in this, let's use government plans, right? Yeah. Let's compare a Roth IRA to a 401k.
Yeah.
So if you put your money in a Roth IRA, it's after tax today.
Yeah.
And then it grows tax deferred.
Yep.
And under current conditions, when you're an certain age, you could take that out tax free.
Yep.
So some people are like, well, I'd rather put in a 401k because then I get more money to go in the plan, that gets to be deferred. But here's the thing. If you take it out lump sum, you're going to have the exact same amount of money as the Roth IRA if taxes remain exactly level.
Yeah.
Right?
Yeah.
Because you're either paying 30% today or 30% when you take it out.
You got to realize no matter what, 30% of your money going in or coming out
but
is
Chris,
the government.
People think that they've had more money grow. So they're like,
and you know what it does? It builds a false sense of security for people.
And the only way it does work to put it in a deferred plan
is if taxes go down.
Is if you're only living off the interest.
Right.
Or taxes go down.
Yep.
In a Roth, you don't have to live off just the interest. You could pull out the principal because it's not taxable. But if I'm just going to live off the interest, 401k might be able to produce more cash flow than a Roth if it was apples to apples, meaning the same amount of money going in. But if you just lump sum pull both of them out in the future, identical amount, maybe identical amount. Here's where it might not be. 401k might get taxed at a higher rate if you pull it out in 1 year, because you could push yourself into a higher tax bracket when you go to withdraw it. And maybe you don't do that, but maybe your heirs have to pay that when it goes to them. Now, I know there's things called stretch IRAs, but I call those, if you do it right, nobody ever gets the money.
But but still, but at the end of the day, like, we've been living in the lowest tax rate environment of all time, and our debt and national deficits are the highest they've ever been. And so where do you think taxes go up? You can't draw blood from a rock. You know, like, the government is going to have to deal with this at some point in time. So if you, like, I would say to you, if you feel like taxes are going to stay level or go down into the future, then a 401k is fine. If that's your risk profile and that's what you want to do, and that's but if you think taxes are going up, you're injecting so much more risk into your strategy in a way that you don't control. And to me, that's just totally out of alignment with what I believe.
It's risk. Everything here is risk. So he's even talking about, why wouldn't you buy term? I consider myself self-insured, right? And we've talked about this on a previous video, that self-insurance is no insurance, which means your assets become your insurance, which means you can't spend more than just the interest without the risk of disinheriting yourself or your heirs. And so...
And let's talk about this. So a lot of people make the argument, like, because I would argue there and say, all right, if that were the case, this whole idea of self-insurance, why do the wealthiest people on the planet own more life insurance than other people, right? And it's because they get the value of the fact that mitigating risk, self-insurance, the tax benefits, all this stuff. I would argue that if the middle class to lower class understood this, they could actually, maybe next generation, not be middle or lower, right? Like, they could do stuff to elevate, right? But a lot of people look at it and go, oh, that's not where my values are. It's not my responsibility. I don't want to take care of my family like that.
Also, don't forget that many 401k plans offer a company match that you should never leave on the table. Now, first off, here's why you might want to leave it on the table.
Yeah.
It might take 5 years to vest and you might not be there.
Yeah.
You might have 29% interest rate credit card loans, and it would be absolutely more imperative to pay that off than to get a match.
Yep.
You might not have any liquidity and don't have enough savings. Those are three reasons alone. Yeah. And do the math. Like, here's what most people don't do. Maybe they've got a couple $100,000 in their retirement plan and they're 50. They've got 5 more years and they're getting a match. They think that's free money. That's 100% return. Yeah. But if you run the numbers, it's only matching the dollars you put in, not the previous dollars that are there. So it's not actually 100% return. Right. And if you look at the actual impact on your overall return of your plan, people would be shocked that it doesn't do as much as they thought. Now, I'm not saying not to take a match. Sure. I'm just saying that to say never leave it on the table is reckless advice, because it would be like us saying everyone should do whole life every time.
It just shows how emotionally charged he is, right? Yeah. Like, for somebody who's claiming that we're, like, out there bamboozling people, like, with the information that we're giving, and then he makes, like, emotionally charged comments like that, it's just ridiculous.
We showed a term insurance policy that if you lived to age 77 and started at 40, that you would have paid as much in death benefit in premium. Yeah. So that was another thing that we showed. Yeah. And he's saying to buy term. I mean, again,
but he doesn't care. He self-insures.
Right. Which means his assets are locked away, because his assets become insurance, which means every dollar he has in assets is at least costing him more than $1 in insurance, because it's, again, a lack of understanding of risk management. Which,
can I talk? And this is a little bit of a pivot, but it's I think right on point. Like, the funny part about, and I know nothing about Mark, right? But the people that perpetuate this conversation, the Dave Ramseys of the world, right? What they do is they say, buy term and invest the difference, and you can self-insure when you hit retirement. Your house will be paid off. Your bills will be low. You don't need insurance. The fascinating thing I find about that conversation is that life insurance is never a need product anyway, right? Like, and to me, like doing this is a character-based product. It's like, I love my family. I, as the provider, as the creator of like trying to like take my family to the next level, take that responsibility on. I don't want to just leave money to my kids, but I want to like create financial systems and teach them principles and, you know, all this stuff that we talk about. And like the only way to do this and guarantee it and do it in the most tax efficient way is utilizing permanent life insurance, whole life insurance, right? Like Dave Ramsey, for instance, he preaches all these biblical things. Whatever anybody believes or doesn't believe, that's not what this is about. But for him to be like Bible based and all these things, and then which I think the Bible says something about, you know, leaving the next generation better off, right? And then to like just take that off the table and say that doesn't matter. You're self-insured. It like leave your kids what you have, but you're leaving it in a less efficient way. And you're injecting risk into your ability to leave it, right? That's what we're talking about.
Yeah. I mean, if Mark truly is retired and that was his goal, then great. Happy for him. I think that's why maybe he has time to watch all the videos is because he's in retirement.
He's bored.
But the question is like, where can he add the most value in this world? And
right.
I don't know if it's this argument necessarily, although he has added value. The fact that we're talking about it right now.
Totally.
And a lot of the statements that he's put out there has been very, I don't know, they're just statements. They're not validated or factual where we're pulling up some policies. We're showing how the thing works. And, you know, we're not comparing investing to whole life. We're comparing savings structures and vehicles.
And by the way, if anything, out of 2 people online, I can think of probably 4 people on YouTube that are adamant that life insurance is not an investment. We try to teach this. It's me, you, Caleb, and maybe some there's a few.
You know, I like it. There's a few concepts. Those guys are big into
those
that.
guys are amazing.
You know, like all these. Yeah, there's a handful. There's more people that are starting to show up and say that, and it's a critical thing. You know.
But you're right. Like if he's, you know, like it's.
I feel like everything I wrote about in Killing Sacred Cows was dispelling the things that we're talking about here, from self-insurance to this notion of the belief that, you know, hey, I'm just going to fund a 401k, which I said was the greatest sacred cow because it wasn't necessarily providing what it was promising.
Yeah.
Could it be beneficial and supportive? Yes, but it's a tool in the entire chest. And if it's the only thing you're doing, you're putting yourself at a lot of risk.
Yeah.
And we covered that at the very beginning of this. So, we went through a bunch of Mark's comments. Mark, hopefully this helps you out. If there's more details that we need to share, watch our other videos. You know,
Mark, go get his book.
Go to GarrettGunderson.com/offer, get Killing Sacred Cows and read the book with the time that you're spending. And then make some arguments against the book if that's something that you really feel. But I feel like I'm making a pretty large case there with a lot more detail that should be helpful for you. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from. So go ahead and click through and watch the next video now.